Welcome, everybody. Welcome to Market Mavericks. I'm joined by Mike and Scott. How you guys doing today?
Hello.
Great.
Awesome. That was an enthusiastic hey. I appreciate that.
Amazing. Best day of my life.
There we
Let's
go.
go.
There we
Let's
go.
go.
All right.
All right.
Pumping it up with some volatility in the markets. We've got lots to talk about, guys. I mean, the VIX spikes to 65, then it's now retreated back into the high 20s, I believe. Bitcoin takes a dump to 49,000, back to 50. What is it, 59 right now and change?
Yeah.
So where do we start? Scott, why don't we start with Bitcoin? I know a lot of people are here for the crypto markets.
Yeah, I mean, it definitely made a lower low, so it's hard to say that it's still quote unquote ranging as we've sort of argued this whole time, but very much in line with price action from previous halving cycles over the summer during that 6-month period before you see any action. I mean, I think we ended up with a 34% retracement peak to trough here, 74K down to about 49-ish, depends on the exchange. Higher than we've had this entire cycle. We were talking about how shallow they were. That's more in line, like I said, with past retracements. I think there's quite a few reasons that we saw some downside. We obviously reached sort of peak hype, as Mike pointed out last week on Market Mavericks. And I was saying there's nothing but tailwinds. He said that's when I start looking for puts. Well, you would have had some pretty profitable puts over that 4 to 5 day period, Mike, to your credit. You know, the Trump speech, the everything going our way, it's a pretty good time for somebody in a lower liquid environment to make a whole lot of money pushing the market around. But that said, the candle on Monday was the biggest volume we've had on a daily candle in Bitcoin in years. And when you see huge volume on a breakdown of a fundamental level, you have to pay attention. You can't just outright dismiss it, I think, first. So I'm certainly not convinced anything here in either direction. Nothing would surprise me if we went back down and filled that wick down to 50. That's what you'd normally see on a day, in the weeks after. But it's Bitcoin. If I woke up tomorrow and we were at 70, I would be equally unsurprised.
You just quickly jumping into just question Scott on something, and Mike, we'll go to you in a second. But we saw this big drop, and it coincided with the stock market falling. I know, Scott, you've talked about how it doesn't seem to be as correlated as it used to. Do you think in higher fear periods like what we've seen recently, it is back to correlation?
Yeah, everything correlates in a black swan to one, and we know that. I mean, listen, even gold, which has performed relatively well or stayed flat, it went down that day. Dollar went down that day. Bitcoin went down that day. Every market went down that day. You didn't even see the inverse correlation of DXY versus other things. That, by the way, makes a lot of sense because obviously the yen is a huge weighted part of DXY. So if it was singularly the yen that was sort of destroying the dollar that day, then DXY going down was a temporary thing, sort of in a vacuum. But yeah, I think that you get these days where everything kind of correlates, but look how big we've bounced, right? I mean, 49 to 59. You could say we were at 60-ish before those days. We're above where we were at the actual drop on Monday. So to me, this ends up being really obnoxious, very volatile chop that's going to wreck everybody on leverage in both directions.
I'll piggyback on that. The VIX pump in the 60, that was a tremendous buying opportunity for Bitcoin on Monday for traders. And I think that's the differentiate now, trend versus trade. To me, shifts are happening, as Raul Paul says, and the shifts are tilting towards a very low volatility environment to volatility tilting upward. And that's one thing I want to show in my first chart. The bottom line, this was a key signal that made me a lot of money in 2008. That was when that VIX volatility index bottom from, this is a 52-week moving average. That's what I show you in the bottom. It's just starting at the bottom. And it's also, if you take the issue about correlation, I just showed this is a 200-day moving average of the VIX overlaid with 200-day moving average of Bitcoin, which is at 61,000, 62,000. So it's bumping up against that resistance. We have gold doing the same thing, and the S&P 500. They're all doing the same thing. They're all heading higher. Just a question which one rolls over. And right now, the only one below that's 200-day moving average is Bitcoin, and that's the most volatile one. So, but the key thing I want to point out is the same thing here. When volatility bottoms from this low, now this is the 50-week moving average of the VIX volatility index. It's just starting to make the turn. That's when traders start getting in. But there's one key thing that I've been pointing out for a while, and Scott and I have had a little disagreement, which we must do. We have to have discourse, and that is, this is what I'm concerned about. It's that 50 to 60 range in Bitcoin. They're stuck between 50 and 60. 60 is now the key resistance. You got to make that a floor. You got to pivot above that, show any kind of strength. But Let's look back. The first time we between 50 and 60 was 2021. Nasdaq was hovering around 13,000. Second time it was 2021 late in the year. Nasdaq was hovering around 16,000. This is the third time we're hovering around 50,000, and Nasdaq got up to 20,000. See the trend there? It's just something I've been worried about. Is if I'm running money for a while, this has been quite a while now. Bitcoin, the fastest horse in the race, is just lagging, and there's some key reasons why. I can show you. I'll just show you a few of the big picture macro, and we'll tilt back over some of the stuff that might not see. When the Nasdaq was up 25% in the year, it's dropped to unchanged, and now it's basically up, what, 6-7%. Industrial metals did that. This is a industrial metals index, 100-week moving average. It had a quick spurt. Now it's down. It's down in the year. Industrial metals are indicative of the global economy. You want to think China and deflation, it's tilting over. I show the same chart with the S&P 500, 100-week moving average. It's very rare for industrial metals to drop like this and the S&P 500 not to do the same. And it's still very stretched above its 100-week moving average. So I'll stop there. But to me, this is all simple mean reversion with good reason. Volatility is way too low, going higher. Part of that was the yen carry trade just getting squashed. The stock market, why is Warren Buffett selling Apple? Partly because, as my colleague said, yes, taxes are probably coming, but because it just became a too big part of his portfolio because prices went too high. You have to liquidate. Just what's happening in this reversion is question how far it goes. So I think from an investor, go ahead.
Sorry, go ahead. Finish. No, I was going to ask you a question about that because I find it really interesting with Buffett. 50% of your position isn't necessarily just rebalancing, right? So there's a lot of speculation. Does this guy know something? But I mean, you think that this was just 50% of a position is pretty big, and a lot of bank stocks as well, right?
Yeah, well, part of it is because I think it was in 2016 that he started buying. My colleague Jonathan Levin helped me out here. Started buying Apple. But when it goes up more than your portfolio, it overweights. And from a risk adjustment standpoint, it's too risky to have something way overweight. Now, some of that's happening with Bitcoin. It's a good problem, but it's what's happening overall. And also he expects more taxes. But that's one thing about Berkshire Hathaway and Buffett. He always knows something. Sometimes he outperforms. But I remember distinctly the key period was in 2009 at the bottom, started just laying it in. I mean, waving it in. Everybody knew that was the time to buy. And now the quote I heard, he owns almost 3% of U.S. Treasuries. It just, there's a time to be overweight risk-off assets like bonds and Treasuries, and there's a time to be underweight overweight risk-on assets. To me, it's the shift is happening now. We're getting the signs. This is wonderful for traders. This is a transition. And unless all these lessons fail, I'll end with this one little one here that I showed last week, but this is unemployment rate. We all know what it's doing. It's going to go to 6%, 100% probability since 1947. And one thing that I showed a little bit last week that most people haven't seen before, if you just take gold divided by industrial metals index, its peak in 2009, it's well above that. It's breaking out higher. And just from a commodity standpoint, I see nothing but global recessionary indications, particularly if you look at something like what's happening in the yield curve. This is the yield curve. This is as long as you can get Fed funds effective rate minus the T-bond rate. It's still 100% spread. It's just starting to go higher. It's the steepest, most inverted for longest since 1979, 1982. I remember that recession. I was young, but my father was running the steel company, so it was a depression. And I just overlay that with gold divided by S&P 500. And that's why I still think the key inflection point here is the stock market kind of has to give up a little bit of its excessive gains over the last couple of years.
We did have that really temporary normalizing of the yield curve for about a second, I think, while we were on Monday, Mike. Yeah, I think we were on Macro Monday, and it went uninverted, but then obviously closed the day and week below.
I was just going to point out one thing real quick. You guys brought up Buffett, and every bull market, I hear the younger investors making fun of him. He's so old school. He doesn't do anything right anymore. He's not, because there are, you're seeing the markets go up and these meme stocks go up, and then he somehow always comes out on top, making the right decisions. I mean, there's a reason why he's the best investor in the world, basically. And just again, proof is in the pudding. Unloading Apple after a huge, what did it go up 30% in the last 6 months, something like that. He had overweighted his portfolio in that. And I think just as an investing standpoint, it was smart to take 50% off after a run like that. I think all of us could learn from that, and taking some profits, leave the rest on to run. It's basically free money. And then also look at his cash pile. He's obviously, I mean, we kind of mentioned this too, is he's obviously expecting something. right? You don't stockpile, what is it, 200 and something billion dollars if you're not expecting something to go on sale sooner or later.
The market hasn't started to follow him yet, because there's one thing we pointed out a little while ago. His cash hoard is high. But if you, and my colleague said, maybe if it's a total investment, it's not. But if you look at the total money in money markets, we have that number. I think it was around $7 trillion. And I'll show you this chart in a second. But of total market cap, the stock market, it's much lower. It's around 10% of market caps versus right before the great financial crisis is closer to 15%. So cash is very low. But this is one thing I want to show you. I don't want to tilt too much, but Dr. Copper is breaking down for good reason. Copper made a new high around $5, $5.20. Classic case of, oh boy, you want to be those hedge funds, managed money net positions get way overweight and long, and then it's crashed. Now it's below 4. Now 4 is the first place you're supposed to be looking to buy it if you're a trader. I kind of stay away from that, but there's a good reason for copper to go lower, and that's this is Chinese government 10-year note yields. And my colleague Stephen Shu, based in Hong Kong, I read his stuff all the time. He covers it well. I thought the Chinese government might be trying to buy quantitative easing, buying their bonds, but he keeps pointing out they are doing everything they can to push yields up because they need to support their currency. Yet there's such a flight to quality in that country, which is very much enclosed, that bond yields are way below, almost still about 200 basis points below the U.S. 10-year note. I think that's where we're going.
Interesting. I just wanted to pivot quickly back to Bitcoin here, guys, and I just wanted to show you guys something here. So notice the flush on Bitcoin took us back to 49,000. That happened to be the high of the approval. That was the high of the bull run on the approval of the ETF before we corrected 20%. And generally in technical analysis, you notice how breakouts above key levels eventually come back and retest those levels afterwards. It's what I call the scene of the crime retrace, coming back to that level. The other thing to note, one of you guys, I think Scott, you might have mentioned the 60,000 level, or maybe one of you guys, Mike might have. But one thing just to point out here is that that's where we are. And if we take a trend line and we start it from this here and we connect it right through this low, look at what this does. It goes right through that other pivot right in here, and it takes us prices right into that. So in terms of resistance, it's right at 60,000 here, or just above. That is a level where I think you can say there's a pivot point where if Bitcoin can get above that and stabilize, maybe it can run back to 70, but you definitely got to take note that there is resistance here around 60,000 on Bitcoin.
Hey, Gareth, I'll take your Bitstamp chart, which I also use, and I'll raise you the Tether chart on Binance and look at that level.
Nice. Right to it, to the
penny.
on
Binance, which obviously tends to have a little more volatility because it dropped to about 48,000. I mean, it's to the tick.
Wow.
To that, the ETF high. So you get the ETF approval, and we retrace the entire ETF approval, and right there, almost to the dollar. It's pretty absurd price action when you take a look at it on that. I couldn't believe it when I looked at it.
I would just say that as well, is that as a technical trader, now this becomes a level where I focus very closely. Like I would still remain net bullish on Bitcoin here over the mid to long term, or well, not long term. I'm always bullish, right? I think overall it's going to head higher, but over the midterm, I think you stay bullish as long as you hold above that high and that 49,000 level. But if you start trading below that, that's where I'd start to get nervous that price could flush as low as 40 or even into the 30s.
That's a good pivot. I'd have to agree with that. I mean, it's Bitcoin's famous for 50% corrections, and I do like looking at that Bitcoin chart. Yes, it looks like a bull flag. It looks okay. Scott's been pointing out that forever. Unless you'd overlay it with some things like the Nasdaq or the S&P 500, it's just sucking wind versus beta, and it has been lately. But there's one thing also I won't tilt too much. I want to show you one chart that is. Part of the reason I've been getting more and more bullish bonds, things like represented in TLT, is because I'm still bullish gold. But if you take gold, divided by what I'm showing here is a Bloomberg U.S. Treasury 20-year plus index. It's basically the same as TLT, but it can go back 30 years. This chart is at a level, it's way above the peak from 2011. Remember, that was the big crisis in Europe. Greece fell. And it looks like it's just starting to revert, but for good reason. I overlay this. If you just take the S&P 500 divided by gold is so cheap, and the S&P 500 is so inexpensive. But the thing is, in history, we've never had this kind of crocodile gel pattern. So to me, that's where I'm always trying to look for what's the next big not just trade, position that's going to last a couple years, not just days. And at least, so maybe it takes a while. It has to take some churning. But to me, this is where it's going to kick in. At some point, we're going to see those severe deflationary forces kick in, which we see happening in commodities. We're up 12% in the year, and they're down. Industrial metals were up 24% in the year, now they're down. We have declining copper. We have crude oil just starting to fail. This, to me, is going to be the next big trade when people say, yeah, gold's great. I still think but gold's had a great move, but what's really beat up, if you take gold divided by long bonds, it's U.S. long bonds that are the most really, I think, the next big potential trade.
TLT.
Aside from bonds, where else can potentially there be a good investment, right? Where in an asset, is there anything? I mean, gold, we've talked about gold, obviously. Bitcoin, I think there's a kind of a mixed picture on Bitcoin. I think long-term, everyone agrees. It's just a question of what happens if the stock market keeps dropping. But is there anywhere else? Like, is there another country where money can go? I mean, is there anything?
Well, I want to show this first. When volatility bottoms from this is a multi-year low, just volatility. But if you take out the T-bill rate, it's a multi-decade low. It's as low as 2007. When volatility bottoms from that, the lesson I learned, as we always spoke about, is bear markets can take money from everybody. It's a rising volatility environment, which we're way overdue for. And maybe just volatility is always mean reverting. So the first question is, as Warren Buffett told us, the number one thing to do is don't lose money. And that's really hard to do after a decade of people learning that if you're not in it, you're not keeping up with your neighbors. That's the stage we're on now. Is people haven't figured it out yet that it's probably over. And the Fed is going to start easing, but they're going to be way reluctant. So I look at those treasuries are still looking really attractive across the curve. I still think gold is going to do very well. But again, also that's predicated on, and we're tilting towards a recession. Maybe we will get lucky. We won't get that. But the bottom line is this is the same signal that the last time we were this low in this volatility index was 2018. But the bottom line, as you see here, is that crocodile gel pattern. The only thing that's kind of unique is this is gold. Is gold going to keep going up? And then we have that, these are moving averages, 200-day. Bitcoin's, we're below that moving average, around 61,000. So
Mike, if the VIX is a good investment, and I think we do think volatility generally increases, but you have to be really careful with the VIX, right? You don't buy it at 65. Needless to say, you'll get crushed. So is there is 20, 25, 18, what's a good area where people can say, all right, well, in this market, that's a good spot?
Rapidly decaying asset has to roll the futures. I look at VIX as a tactical trade. I think the smarter investors are buying it on dips, but you have to have a short-term time frame because it'll crush you and decay. And maybe it's a sign that those people who have been, should be looking to buy overall puts on risk assets on the way up. But I look at it as, from an investment standpoint, just lighten up on everything that's gone up a lot, like Warren Buffett's doing, and overweight and stuff that's safe and it's going to give you. I mean, we have the best yields on Treasury still for almost 20 years. Now they're going away fast. I think they're going to go away real fast. But the bottom line is just when you're not losing much money as everybody else, that's a good sign. But
you're a winner then?
Well, you're a winner. It's relative, but this is a thing that's going to happen. It's virtually guaranteed. As I show you with, I don't know if I have unemployment. Unemployment's going to go up. Where did I have? Right here. It's going to go up. So there's going to be people losing their jobs. It's virtually impossible to stop this trajectory. It always happens. So when it gets to near 6%, what happens is there's going to be things like you have to sell your home, not because you want to, because you gotta. People are already curtailing spending. We're not going to throw as much money at the system because all the lessons of history showed us we threw way too much money on it, and we created the worst evil of all. That's inflation. Inflation helps the rich guys. And one thing we're learning right now is rich guys have nowhere near the voting power as your average person. And once the politicians figure that out, like Trump finally figured out Bitcoin's actually good for the U.S. and and the dollar and all that stuff. Once they start pushing back on this inflation, they'll figure it out, and people, I think voters will go for any type of candidate. Will say, okay, we're going to help keep that inflation low, because that's what hurt most of the people who vote the most. So this is what's happening. When unemployment goes up, it trickles down to everything. Fouls. People lose their jobs, they cut spending, and then also you have that domino effect. But Good.
So I was just going to say, and I'm going to throw this over to Scott and say, I can just hear what everyone's saying who's watching us, and they're saying, wait a minute. So you're telling me if I'm just not losing enough, I'm doing well. Well, what about the 10 and 20, 100x opportunities? Like what? There's a lot of people that are young that's what they're used to, right? What do we do?
Problem. Exactly. They're used to it. And if they've only been trading for a decade, they got to go back and study history. There's some great books I can point to, like the latest for traders, I'd suggest don't trade. And there's one, if you've been if you've been investing for 10 years, you've never seen safe yields this high. It's still there. I still keep saying now, treasuries at this at 4%, it's no longer 5%. That's still better than losing.
True.
I was just going to say, though, for people who haven't been through it and who may be experiencing it for the first time, actually the best thing to do is just get on autopilot, stay on autopilot, and zoom out and don't worry about what your portfolio looks like for the next few years, because the greatest opportunities will be when you turn your brain off and dollar cost average, and in 10 years, everything's back at new highs. Assuming that happens. But I mean, I personally experienced, in 2007, 8, 9, I finally got some money again. I've told the story a million times. I was like, I'm going to get back into dollar cost averaging on SPY. And I mean, I bought it for a couple months every month, and the market just absolutely crashed. Not a single buy I had was in profit for years. And then I turned around one day, 10 years later, we're at making new all-time highs, and I had continued to dollar cost average throughout, and every buy I'd ever made was wildly in profit.
So you got started at a great time, but here's a mantra. You can see behind me, I'm on more of a, it's less of a trading desk, but I spent a lot of time in trading desks. And I remember in 1999, when you started, the joke was everybody's in it for a long term, as long as it keeps going up. And I hear that in cryptos all the time. And I just, sometimes you hear this, and everybody, when you hear that and prices have gone up a lot and you hear that mantra, you say, okay, watch out, be careful, because that will test those iron hands or diamond hands. We haven't really tested them yet, realistically, with the whole market staying down for a while, and that's overdue. Now, here's one thing I noticed the other day is, I think it was Tommy Lee said the market would be disappointed, and if the Fed cuts 25 basis points in September. And Scott, I think you've touched on this, is the Fed might actually prefer that. Partly because we all know the market's so dependent. I mean, on the Fed to cut rates, just these calls for intermediate cuts are just so silly from people that I think were smart. It's just, have you never studied the history of monetary policy? You don't cut just because a market drops up a little bit. It has to be a pretty significant credit event for that to happen.
And by the way, I mean, JP Morgan's saying, I can't vet if this is true, but it's a huge story, saying 75%, I don't know how they quantify that, 75% of this carry trade has already unwound. Listen, if you believe that this was just an overreaction to the yen in a carry trade, there's no reason to do anything, because that unwinds, it takes its time. I think, Mike, what we discussed on Monday is who could be a victim of the contagion of that we don't know about yet, which is what you would be watching for in the future, if it causes some sort of credit event. But right now, if you think it unwound and dollars bounced against the yen, you can go live in your honky-dory fantasy that everything's okay and it was just that thing, and wait until the next inevitable narrative arises for a dip. It really now, I think, I tweeted on Monday when this was happening, during Macro Monday at 9:39, I tweeted, if the market's designed to inflict max pain on everyone, then a huge bounce this week to get people bullish before continuing down would be absolutely savage. And you got to remember, in markets like this, most times anyone using leverage or trading it aggressively is going to get wiped on both sides.
So this is where
I'm not saying it's going to go down. I'm saying that would be a max pain scenario.
So this is where little, I think, experience and it pays off. And that is, I've been really enjoying trying to sense all the calls. And every place I look, right now I look at CNBC, Bloomberg, and CNN, and I absorb as much as I can. The buy the dip minions. It's what they do. It's their sell side mantra to do that. And it's the absolute wrong thing to do from a long-term investment standpoint, because you can't, at some point, there's got to be money. You got to take some profits like Warren Buffett. You have no money left to buy dips. But to me, that's nice, and I had to put that on. Is okay, if you're buying the dip, why are you doing it with the S&P 500 25% above the 100-week moving average? Wait till it gets near there. With VIX volatility index bottoming from a multi-year low, that's when you're supposed to say, thank you very much, I'll sell the rallies. But it's the human nature has flipped so much to get so used to that. That's when you have to be careful and say, what's the prudent thing to do? Oh, U.S. Treasuries, thank you very much. Then you kick back. But that's when I say, and everybody's in for long haul. As long as it goes up, we're going to start learning the lessons that it just can't just keep going up all the time. And the leading indicator, I think, will be Bitcoin for this, unfortunately.
Two questions for you guys. So we were just talking about how people were calling for a inter-meeting cut by the Federal Reserve. But in essence, didn't the Bank of Japan kind of do that, in that they basically bowed to the markets and said, we won't hike anymore during this crisis?
Exactly.
And so,
Yeah. And also the market dropping, which now they can't like it. But on Monday, you had to think that Jerome Powell was sitting there thinking, finally, this is amazing. It's what he wants it to do, so he doesn't have to do anything, right? Like, they want the stock market under pressure. He's probably in disbelief or just unhappy that it's bouncing so hard.
Well, we're in unprecedented time. With the market cap in U.S. at 2 times GDP, which on the way up, as you've heard me say before, is the highest since the late 1920s. It's all that matters. Not only from a markets going down, pulling down inflation, markets going up, pulling up inflation. It's from a human nature standpoint. Everybody feels wealthy. You got to take that away, and at some point the game ends, and it typically ends when everybody says they're in it from a long haul. I mean, like I said, I remember joking around with the traders in a trading desk in 1999, and that was, again, one of those periods I did pretty well in good old zero coupon bonds. The unique thing now is some of them just recently were yielding just as much as they were 20 years ago. So I haven't seen that in a couple of decades.
Interesting. Yeah. And just going back to the dollar cost averaging aspect, I think that's such a great policy, DCAing into quality assets. The number one thing, though, I think Mike and Scott, that you guys would agree on, it has to be quality, right? I mean, you're not talking
to
about
me,
like
it was always an index, just average into the market. Don't even try. Like, I wouldn't dollar cost average into an individual stock as my core investment or retirement strategy.
Yep. And you have to really, like, in a weird way, I think, on a psychological basis, and this is what you were alluding to, Mike, is that you have to somehow shut your brain off, because the market will push your limits on that. And you might have gone into that saying, hey, I'm going to shut my brain off and dollar cost average. And the market sometimes, at least historically, not in the last 10 years since really the 2009 lows, but it will go against you for such a long time that you really start to question that. It becomes so painful that a lot of times the bottoms of markets are where people that said they were going to dollar cost average throw in the towel.
Exactly.
Every time. Capitulation is a thing.
Yeah.
Well,
so it's really like that's really where you almost have to preset it up with the pre-buys and like have someone else change your password so you can't even get in there.
Can't even see it. Talk to me in 10 years.
Exactly. Interesting stuff, man. Amazing stuff. To kind of round us out, what are we looking forward to in the next couple of days? Economic data, earnings are kind of over. I would say overall, my general prognosis of earnings, they were like it really wasn't the robust quality that we were used to. And I think the markets are starting to sniff that out, that there is a consumer slowdown out there. But what are you guys looking forward to in the next couple of days to next week?
I think one thing that was interesting today, Mike, that might be worth noting is jobs, jobless claims came at 7,000 under. I mean, but it beat expectations. And for the first time I can recall, what you would view as good news was actually treated by the market as good news. Usually when we see good job numbers, the market dumps because that means the Fed's less likely to cut, right? In this sort of upside down world. And things actually have gone up since I can't say they're correlated, but I found it interesting that good news was not bad news today.
So I'll end with this. I want to show my screen. First of all, the economic surprise index is at about a decade low. This means that all the data has been worse than expected. And for next week, the key thing is CPI, PPI, retail sales. The key thing I've been pointing about retail sales is people say they're great, but if you subtract out CPI, the annual level, it's been as bad as it was. But I remember in 2000, before that crisis, and right before the great financial crisis. And I do enjoy, as I've been earned that nickname McGlone, I just like to say I'm McFacts. These are the facts. Ignore them at your will. And I think it's better off to not just expect markets to go to the trees to never stop growing, but there's also times when you're supposed to underweight risk assets and overweight risk off assets. And the treasuries are still giving you decent yield. Now, here's one thing I want to end with is commodities are accelerating their deflationary force. The depression in China, believe it or not, is accelerating. Just looking at their bond yields. And the Fed's going to be cutting rates very soon. And the U.S. stock market is the most expensive in my lifetime versus market capitalization. If there's ever a time to kind of be careful in risk assets, it's probably now expecting bond yields to bond yields to fall, inflation to fall.
Yeah, well, I like that ending point. You got Gareth Soloway up here. You got McGlone. I'm not sure about Scott though. We got to figure out a good nickname for you, buddy.
I'm a bit confused. Right now, I just I refuse to say I have any idea which way it's going to go because I can see an equal case for both.
Amen. All right. Have a great one, guys. Thank you so much for tuning in, everybody. Great episode today, and we'll be back next Thursday. You guys have a good one. Take care.
Thanks, guys.